All right, so we got a lot to talk about today, not the least of which is going to be our final discussion of the semester, final lecture of the semester, but also some announcements, which I'm going to try to burn through these pretty quickly so that we can actually get to the fun stuff, which is going to be the second part of the financing investing process. So, first of all, on your homework that's going to be due on Friday, you have a final earthware clothiers assignment. Please make sure you read the instructions closely on that assignment because it does specify that you need to turn in your final tab of the workbook and a summary of your results, not the entire workbook. The entire workbook is huge. It's not actually that difficult to complete. It will probably take you like 5-10 minutes, but there's a lot of detail in there. I only want the final tab and the summary results. That's all I want for the deliverable. So please make sure you follow those rules. Presentation dates have been selected. I've updated the spreadsheet. So we've got one group that selected AI auditing. I still need a presentation topic from group number 3. So please make sure you can collaborate and get on that. If I don't have a presentation date on Friday, then I'll give you SOC reports. Because everybody loves SOC reports, right? Yeah. All right. So make sure you talk amongst each other and get that resolved. And then Excel assignments, I believe Clayton is pretty much done grading. He may have 1 or 2 left, but he shared some results with me. They looked really good. So thank you very much for taking that seriously. I wish I could say that's been the case for all of my Excel assignments in every semester, but the reason I harp on that and make sure everybody gets on top of it really, really quickly is because it hasn't been the case in the past. I've had some truly miserable Excel assignments submitted with, well, some people not submitting at all. So 0 points is certainly a problem, but I've had a 2-point submission, which was pretty interesting, 2 out of 20. So that was a challenging one. So nobody, was that?
Got it.
They got it in, yeah. Barely, It was a spreadsheet, let's put it that way. Yeah. So yeah, there's that. Nobody was in that range. Everybody did very well. Finally, on Friday, we're gonna have our homework. We're probably gonna go through the homework really quickly because we will have that day the Business and Economics Advisory Board will be here, as well as the Accounting Program Advisory Board. They're supposed to be releasing around 2 o'clock, and we're going to have Matt Maynor, who's an audit partner from KPMG, come and visit our class at the end of class. He's only going to be here for like 10 minutes, and I've asked him to share a story that I think people might find as relevant. But I did want to make that announcement that he'll be here for that, and then he and I are meeting afterwards. If you want to stick around after class and have some questions for him about careers in auditing, about professional path, about direction, just what to expect, then you're more than welcome to stick around for a few minutes afterwards and talk to him. But he'll be talking really quickly at the end of class, and I just wanted to make you aware of that. You can also ask questions in class, though I'm not sure how much time we'll have actually during class to ask questions. With that, get to our final discussion, final lecture. So we're talking today about 2 specific areas. We're going to be talking about cash and then investments. Now, does everybody remember what we said about auditing cash in the previous circumstances? How difficult did I say auditing cash was back in materiality? It's easy. Yeah. If I ask you how much cash you have on hand, could you tell me that? And probably say, well, I'm a college student. The answer is none, Dr. Barnes. And I'd say that's fair. But more literally speaking, if I were to say, how much cash do you have in total? You could count the cash that's in your wallet, count the cash you have set at your other sources, and you could go to your checking account and check that and see what your balance of cash is. It's very, very straightforward. And it doesn't change that much for how we audit cash in the real world. But there's a focus that there's obviously a focus on cash because it's one part of a single chapter in the course. Why do we have to focus on auditing cash? And the answer is that same reason that we talked about inventory was so paramount and some of the other areas were paramount is it is very susceptible to fraud, extremely susceptible to fraud. In fact, cash is the most susceptible to fraud because it's the most liquid asset. It's a bearer instrument, and if you own the bearer instrument, then you have it. So we're going to talk about some concepts, and then we're going to go on to investments. I will tell you that what we're going to cover in investments is very high level. We're going to cover some high level concepts. I do not expect you to be experts in how to audit investments, but I do want you to have some general knowledge in the area. So what does cash represent? Well, obviously currency on hand. So whatever's in your wallet, you can count. Cash in bank accounts, and that includes certificates of deposits and time deposits, and didn't even savings accounts. Okay. But if you remember, if you've ever looked at a 10K or an annual report, it doesn't just say cash. I mean, maybe early on when you were in 220, it said just cash by itself. But usually in the more advanced stages, you start seeing this thing called cash and cash equivalents, okay? So what does cash equivalents represent? So you can kind of see some examples of cash equivalents that are listed out here, treasury bills and money market funds. And basically these are short-term, highly liquid investments that if they're readily convertible to cash or very near to maturity. So there's very little risk of changes in value. Now, the way to think about this is relative to other assets, cash equivalents basically will give you the full value of whatever their exchange is. So if I exchange a treasury bill for cash, it's going to be whatever the face value of that bill is. Whereas if I did something like selling an investment, it may not be what I paid for it. It could be more or less. There's going to be a difference in value. So we want to make sure that we refer to cash equivalents as something that basically the face value of that investment is effectively what it is we could realize or recognize off of that. So cash and cash equivalents, as I said, are frequently combined for presentation in the financial statements. Now, the good news is we're going to cover a little bit about how we audit cash and how we audit cash equivalents, both from the perspective of it being cash and the perspective of it being investment. We're going to talk about both of those today. Now, think about this. We talked about the reason why auditing cash is so important because it is very susceptible to fraud. But there's another reason that's probably a little bit more straightforward. How frequently does a business use cash? Once in a while, they might pay for things once every 2 or 3 years or so. Can we say that cash has a big effect on the business? Yes. Every single process that we've discussed so far is affected by cash to some degree. All right. So we can actually look at sources of cash or disbursements of cash, and all of our process areas that we've talked about are going to be affected by cash. So it's very important to understand what our cash position is in order to have proper functioning. And you probably heard this in your previous financial accounting courses, but an organization that cannot generate cash effectively is not an organization that will stay in business. There's this joke about people who generate massive amounts of income but never actually really realize the cash or recognize the cash of this. And so it's actually, the joke I remember is from old Archie comics, which I know that Archie is kind of like associated with Riverdale, but I'm talking about a more innocent time when the jokes were kind of harmless. And so Archie and Jughead are having a conversation, and Jughead is trying to sell a bathtub, and he's got it listed for $1,000. I said, "You're never going to sell it for $1,000." And he comes back, and later, and the bathtub is gone. And he says, "Oh, you actually sold it for $1,000?" I said, "Well, kind of. I traded it for 2 $500 trash cans." So yeah, a really, really silly joke. But that's kind of the amount that we assign to something is irrelevant or it's erroneous if we cannot effectively convert that to a cash value. So that's going to be the focus of many organizations, is how do we not just generate income, but how do we make sure that that income is equivalent to cash at some point? All right, so let's go ahead and talk very quickly about the types of bank accounts that we can do audits for. So the basic bank account is going to be the one that we're going to focus on, are going to be general cash accounts. And this is the primary cash account held by an organization. Usually they can have multiple cash accounts for different operations. If you remember when we did back in NetSuite, when we did purchasing activities versus revenue activities, we had different cash accounts for those activity areas. But general cash accounts are going to be held by the same organization. It's going to be the primary cash account. Then we've got some other ones that are going to be very important to note. We've got something called impressed cash accounts. Has anybody ever heard the term impressed cash account before? So an impressed cash account, I want to make a joke about it being very impressive, but that's just not true. Okay, it's not actually that impressive at all. Basically, an impressed cash account is a cash account that is set where cash is set aside for a specific purpose. So you've heard the term sinking fund before, where cash is set aside for specific investments. Usually, a sinking fund will be set up in an impressed cash account, so that only transactions related to that particular activity or that particular function can go in and out of that particular account. So the sinking fund would be deposits related to that transaction or that plan or that whatever that item is when they're going to be associated with the sinking fund. And then disbursements will also be related to that transaction, series of transactions. Then we have branch accounts, and branch accounts are a little bit interesting simply because these are more relevant for really large audits. Now let's put this as a practical example. So let's assume that we're auditing Walmart, okay? And our Walmart has a general cash account of Bank of America. I have no idea which bank account is their general cash account, but let's assume that's their general cash account, okay? So we're doing an audit of the Walmart here in Kirksville, Missouri. You're going to count the inventory, you're going to do an inventory count observation, you're going to audit their cash function. And so you're trying to determine if the cash balances are correct. And so you go to the Bank of America branch here in Kirksville, Missouri to get that information, right? Does anybody have a problem with that statement right there? There's probably something there. Dr. Barnes wouldn't mention it otherwise. How many people have seen Bank of America here in Kirksville, Missouri? There is no Bank of America bank in Kirksville, Missouri. Okay, so if that particular store that store needs to operate, it's not going to operate out of Bank of America. Its accounts are going to be out of one of the local banks, like Equity Bank or U.S. Bank, something that's set up here in Kirksville where they can have ready access to cash. So that's what we mean by branch accounts, is that for smaller level operations, they do need to set up accounts occasionally, simply because that facilitates local jurisdictions or local operations. Okay, so cash receipts and cash disbursements. How do we audit those? The answer is, let's go back and look in chapter 10 and chapter 11. Okay. When I say let's, I mean you. Okay. So that's how we already talked about that. We've already talked about how to audit this stuff. We've already talked about it, go into detail on this. So the control risk assessment for that, remember those two tables, or those two tables that relate to cash receipts and cash disbursements? That's going to be your area of focus for that. All right. You don't need to really worry too much more about that. An additional cash control, though, that we are going to talk about and go into a little bit more depth about is something that you should be familiar with. That is the bank reconciliation, which is periodic or usually on a monthly basis. Now, I mentioned this already. We are not going to develop our own bank reconciliations in this course. I used to do that back when I had extra time in the course to do stuff like that. We are going to talk about how we audit the bank reconciliation, and it's pretty straightforward, but we'll get to that here in just a second. Now, if a client has effective bank reconciliation procedures, the auditor may choose to test the entity's reconciliation procedures for tested controls. The good news is this can actually serve as a pseudo dual purpose test, which basically means that we can use this as part of controls procedures, but it also can be used as part of substantive testing as well. So we can actually get assurance in both areas. And the reason for that is pretty straightforward, because the bank reconciliation itself is a control, but the balance of cash itself is a test of account balances. So I'm probably going to take a lot of pauses to drink. For some reason, my throat is sore right now. I don't know. Now, I have a question for you, and I'm going to have my friend Dwight Schrute prepare this. All right. So he says, does cash have a predictable relationship with other financial statement accounts? What do you all think? You know a lot about cash. You've done balance sheets and financial statements already. So can we set a predictive relationship with other accounts? Well, Mr. Schrute would say false. He says that's not the case. And if you think about it, it makes a lot of sense. You may say, well, this account is affected by cash. And I said, well, what about this account? That account is also affected by cash. And I could point out pretty much every account on the balance sheet and many on the income statements that are affected by cash. So it means if I look at one account and try to judge what's going to happen to cash by looking at one account, I'm leaving out a whole bunch of other accounts that affect cash. What does this mean? It means that using a model on cash for substantive analytical procedures is completely and totally pointless, because we'd have to model based on so many different accounts and accounts that are moving in multiple different directions at the same time. So you can actually see an organization that has positive income and see negative cash valuation at the same time, simply because the cash goes in so many different directions. We actually know the three directions it goes: operating, financing, and investing activities. Remember the statement of cash flows? Yeah, so those all represent different directions for cash, and there's multiple different directions within each of those that can actually go. Ultimately, this is all to say the use of auditor's use of substantive analytical procedures is generally going to be fairly limited. It's going to be limited to comparisons with prior year cash balances, so a basic trend analysis, all right, looking at what happened in cash from a previous period. Even that is somewhat limited, because we could see positive operations, but we could see negative cash flows. In fact, if you go back and you look at Netflix back in the late 2010s, their cash was just a mess, okay, because they were outlaying cash for all these new TV shows they were developing and all these new movies, these original stuff they were doing. It actually paid off for them in the 2020s. They hit big, and now they're kind of one of the big streaming subscribers or suppliers. But they had negative operating cash flows for a period of like 8 or 9 years. Okay, so that was something that was a very, very worrisome time for them. If you go back and watch some of my videos back from that time and say, yeah, Netflix is just dying. They're never going to survive into the 2020s. And then the pandemic hit and everybody just watched Squid Game all the time. So yeah, I ate my words on that one for sure. So comparison of prior year cash balances, and then comparison with budget amounts. That's something that could be a little bit more relevant of use, is to look at what the balance should be and what the balance actually is. All right, moving on to substantive tested details. Some things that we can do as substantive tested details is test our transactions events and our account balances. Now, this is an interesting one, because I've got all these assertions listed, but I've got the last one on account balances listed and then crossed out. Why do I have rights and obligations crossed out? What would he say about cash? What do we say it was what type of instrument? a bearer instrument, okay? So how do we establish rights and obligations for cash? Whoever possesses it, okay? Whoever possesses the cash, all right? So this is a bearer instrument. There's not really any rights and obligations associated with it. We don't have to prove rights and obligations. If the organization has it, they have it. That's good. Again, of course, assuming that we ignore the fact that it's held in the custody by third party for bank accounts. As long as the bank account is in that name and it's for a certain amount, we assume that they have the rights and obligations to that, or the rights to that cash. All right. So some examples of testing that we might do for substantive tester transactions are listed here. You're going to notice that these look very familiar because these are the same transaction tests that we did back in chapters 10 and 11. So again, we don't have to learn too much more here. The types of tests that we did for revenue and purchasing are going to relate. Now, I do want to throw a caveat out here. I'd like to use that word a lot. For some reason this semester I've used it a whole bunch, but I do want to throw a little bit of a side out here. Cash receipts is not necessarily just restricted to revenue transactions. We can have cash receipts through other areas. Same thing as cash disbursements is not solely restricted to purchasing transactions. But by and large, the majority of our transactions in those areas are going to be are related to that, which is why we can kind of bundle this all together and say, we're going to do majority of our cash receipts testing as part of the revenue process, and the majority of our cash disbursements testing as part of the purchasing process. So what else can we do? What else can we look at? So let's go ahead and take a look at the idea of testing specific assertions with respect to testing the bank reconciliation. So for existence, we're going to actually can obtain a confirmation from the bank financial institution, which is consistent with what we've talked about for other asset categories, especially those that are short-term in nature. We talked about accounts receivable. We talked about other ones. So we could do it for prepaids, but cash is another one that we can obtain a confirmation to test existence. What about if we want to test completeness in VAA? Well, then we can do bank reconciliation testings for each account. We're going to go into a little bit more depth on this. You don't need to worry too much about the list that's here because we're going to talk a little bit more in detail, but the answer is we're going to test the bank reconciliation to test these other assertions to make sure everything has been recorded and recorded properly. So completeness and VAA. Now, I do want to throw a little bit of a note out here. I kind of disagree with the word trace here. I know what the implication is that the book was trying to say if we're tracing, we're testing specifically for completeness. At this point, I think that it's a dual test of both VAA and completeness. So I tend to use different terminology here, but we'll see that here in just a second as I break these points out a little bit more in detail. So what are we going to do if we want to test the bank reconciliation? So let me ask you a very, very basic question. If I want to, as an auditor, I want to test the bank reconciliation as part of a controls test, but also my test for account balances. What is the very first thing you think I'm going to need? The bank reconciliation. Yes, I want to have the bank reconciliation. So here's an example of bank reconciliation from the book, okay? Want to have the bank reconciliation. Now remember, the bank reconciliation that you learned back in 302 will still be applicable here. All we're doing is we're looking at the bank balance and the book balance and adjusting for any differences between the two. All right. Now, I'm not going to go through that if you don't remember how the bank reconciliation works. Remember that the bank adjustments are for the checks outstanding, the deposits in transit, and any transaction fees that have been recorded. And then the book balances are any transactions that have not been recorded yet that need to be recorded, any adjustments that need to be made. Also, any errors that are relevant between the two. So that's going to be a basic thing that we have to have. We have to have the bank reconciliation to understand how did they reconcile what was in the bank to what's in the book. Is it very common for the bank balance amount to be exactly equal to the book balance amount? In a large organization, it's very uncommon for that to happen. Could it happen? Probably, maybe like a 1 out of a million attempt, okay? Even then, you would still want to test it because it's likely that you've got entries that are just offsetting one another or transactions that are offsetting one another. So the second thing we need to do is we need to think about how we want to test this. What are we ultimately trying to prove? Are we trying to prove the bank balance is correct or the book balance is correct? The book balance. We want to get that book balance, okay? So that's what we're trying to verify. But remember, the book balance is just a function of what the bank balance is, and then any adjustments to that bank balance that reconcile it to the book balance. So logically speaking, I want to make sure the bank balance is correct, and then I want to test everything that falls in between the bank balance and the book balance. So let's talk about the first. What's an easy way to verify the bank balance? I'll give you a hint of something we've already acquired. Confirmation, yes. Okay, we're going to send out a standard bank confirmation. So basically say the same thing we would have said for any type of confirmation is that what is the amount that's being held in this account? Or if it's a positive confirmation but not a blank confirmation, we can say, here's the amount that the client has listed. Can you verify that this is correct? And the bank will tell us yes or no, and then give us the correct amount. So if you look at the bank balance right up here, the bank balance is this amount listed, and it's got a little bit of a footnote here. It says C, and it's basically says trace to the bank confirmation or standard bank confirmation. Or it says trace to the bank confirmation, but it's actually the standard bank confirmation. And you're going to see an example of that in your homework, by the way. So it should be pretty straightforward to follow how that process works. So we've got the bank balance. We're still trying to prove the book balance. What do we need to test everything? What do we need to test? Everything in the middle. Now, the majority of these transactions in the middle are going to represent transactions that, given enough time, they should naturally reverse themselves. Think about a check that's outstanding or a deposit in transit. If it's a legitimate transaction, what should happen within a few days? They should clear the bank, right? Okay. All right. So is it possible that we as auditors could say, all right, we're just going to wait a few days and then we're going to look and see what the bank activity looks like. And if those are cleared, we've got evidence that the information that was in the bank reconciliation is correct. You see where I'm leading you down a path right here. Okay, I'm leading you down this path. Yeah, the idea is that if we wait enough time, that we should be able to see these transactions clear. If the transaction doesn't clear, that's something we have to investigate further. So we're going to acquire something called a cutoff bank statement. And what a cutoff bank statement is it basically says 7 to 10 days after the bank reconciliation, we're going to request a new bank statement with the updated transaction history. Now, 7 to 10 is a little bit more of a historical amount. I could say that in modern terms, this is something that was commonplace back 2 decades ago, when still there was a heavy history of paper check transactions. Paper check transactions tend to take a lot longer to clear than electronic transactions. Now, most large organizations, they operate through electronic checking, and so we could actually go with a much shorter time period, but 7 to 10 is still kind of recognized as a principled depth or length of time. If something is not cleared after 7 to 10 days, there is a problem with it, something we have to effectively check. So we're basically looking to the future and we're saying, let's compare this to what was in the bank reconciliation. Did this check clear? Did this check clear? Did this check clear? Did this deposit clear? And if the answer is yes, we've got a lot of assurance that the bank reconciliation is correct and the bank balance is correct. If the answer is no, then we still need to investigate any of those individual items and clarify to make sure if they are properly reduced or properly removed, or if they need to be adjusted for some reason. But this is kind of our ultimate litmus test where we say, can we actually validate the difference between the bank balance and the book balance? And hopefully the answer comes up yes. All right. So real quick, there's a few procedures that are listed here. These are just the procedures that were kind of listed in commonplace with vernacular used earlier about what it is that we would test on the bank reconciliation. So testing mathematical accuracy, testing the bank balance and the confirmation, comparing the deposits and transit, comparing the checks and making sure that we can actually see the checks. If they're paper checks, we can actually see the checks themselves, the canceled checks or proper pay and amount endorsement. Any additional charges that are not included in the above 2 categories, we want to make sure that those are covered in the reconciliation, and then we want to agree the adjusted book balance to the cash account lead schedule. Now you'll notice I did not use the word trace anywhere in there, all right? And the reason why is our primary focus here in this testing is going to be on VAA. It's not to say completeness is not important, but I think the VAA testing is more important. And so just as a reminder, tracing implies source to record, vouching implies record to source, agree or compare is source to source, which I tend to view all these transaction documents as source to source records. Now, it could be argued that we're doing some tracing testing here, but I would think that's in joint unity with the testing the source to source documents. So there's an implicit direction there, which would give us some assertion about completeness. But for purposes of sanity in this class, I think that we should just think about this as mostly a VAA test and that we're agreeing source documents to one another. I think it's the simplest way to think about it, and it makes most sense. That being said, if Matt Maynard comes in on Friday and starts talking to you and say, "What'd you learn?" He says, "Well, completeness is not relevant to bank reconciliation testing." If that's the case, I will throw an eraser at you, okay? But because I'm not saying that, I'm just saying that for the most part, the easiest way to think about it is a VAA test is primarily what we're focused on. We don't have any erasers up the open. There's an eraser down there. Okay, that would actually hurt. It looks like it's got plastic on it. I won't throw any erasers, anybody. Sorry. Okay, I'll throw whatever this thing is right here. It wouldn't hurt, but it's really dirty. It would make a mess. Okay. I'm not afraid to make a mess. All right. So what happens if the client does not have adequate controls over cash, or the auditor suspects that some sort of fraud involving cash has occurred? I want to tell you right now that what you will need to know for the exam is how to do the detailed cash reconciliation procedures. You will need to know the steps and the processes. You will need to know how to walk through each of those steps. So those three documents and what they are. These next three items, you just need to know the names. You don't need to understand the explanation. So the three items are how to extend the audit procedures over cash. We want to do extended bank reconciliation procedures. So basically what this means is that we're going to do a bank reconciliation, but we're going to do a bank reconciliation over a period of time, not at a point in time. So looking at the entire month instead of looking at what the result is at the end of the month. We also can perform a proof of cash. That's just trying to reconcile cash at any point in time during the period to make sure we have the correct balance. And then test for kiting. This is kind of outdated. This occurred quite frequently back when paper checks were heavily used. We can still do tests for kiting, but oftentimes this is one of those ones that doesn't get performed very frequently nowadays because electronic transactions have made that obsolete. But it would actually trying to test the timing of check or transactions between bank accounts to see if somebody's trying to use that float time to overstate the balances in the accounts. So some additional notes regarding cash, okay? Auditing a pressed cash account or payroll, so for payroll or a branch account, they follow the same basic procedures as auditing a general cash account. So testing the same way we would for revenue and purchasing procedures, and then also doing reconciliation testing. Those would all follow that same pattern. And then we have this thing called petty cash, okay, which is a cash account that's used to pay for minor expenses. Again, this is somewhat outdated. A lot of organizations don't even use this anymore simply because many people who are making purchases, they've got their own credit or debit cards that they can use to make purchases of minor amounts. But if you do encounter an organization with a petty cash account, what would you do? Would you want to perform substantive procedures? No. It's a non-material account. It's not material. So doing testing of substantive procedures is probably going to be a waste of time. We would just want to make sure the controls are in place here, particularly with respect to segregation of duties in this area. We would want to make sure that there's proper separation of responsibilities, specifically over custody of cash, and then who authorizes the transactions and who records the transactions. All right, last slide for cash, okay? So auditor must evaluate several types of financial statement disclosures related to cash. Some of the more common disclosures, we want to know what the policy for defining cash and particularly cash equivalents is. We want to make sure we identify any restrictions of cash. We talked about that earlier. Impressed accounts are used for restricted cash for a certain purpose. We want to know what restrictions exist and how they're treated. Contractual obligations to maintain compensating balances. What are compensating balances? Has anybody heard that term before? So basically, this is something if you say, for example, you get a line of credit through a bank account based on a revolving line of credit, which would basically represent a liability to the organization. So you can make purchases on account. They would say, in order to get a line of credit with our bank, you also need to maintain a bank account balance with us of, say, $10,000. The idea being is that if you default on that line of credit, they at least have some recourse. So that's a compensating balance. Basically, you hold a certain amount and a certain amount so they can actually recover that if things go wrong. Cash balance is restricted by foreign exchange controls and any letters of credit. Those are somewhat minor. I wouldn't worry too much about those. Let's talk now about investments. So investments, common stock, preferred stock, debt securities, and our friends, hybrid securities. Remember the hybrid securities we talked about last on Monday? Same concept here, except instead of being the one who are issuing the debt or issuing the equity, we are now the one who are purchasing this debt or equity, okay? And a lot of our principles will hold true that we learned from Monday. So we're going to see a lot of repetition here, but there's going to be some nuance that we need to talk about here. So with clients for a large investment portfolio, the auditor is likely to follow a reliance strategy. So if we're talking about a company whose entire business model is based on investments and acquiring investments and selling investments, we would want to test the controls surrounding that function. Most organizations, they do have an investments, but it's not a large part of their business model. So if that's the case, we're just going to use a substantive strategy. So we understand the reason behind that. We talked about that on Monday. Most transactions in this area are going to be minimal, okay? There's going to be a minimal volume of transactions, so it's easier to audit the transactions themselves than the surrounding controls. So again, a little bit of a differentiation there. If we're talking about an organization that is just entirely focused on investments, then yes, we would want to follow a reliance strategy. Most organizations, we can use a substantive strategy in this area. So what are some assertion concerns we have in this area? All right. So first of all, with respect to completeness, we want to make sure that all security transactions are recorded, which makes sense because completeness is our recording assertion. With respect to existence occurrence, we want to make sure the controls ensure that purchase of any sale or investment is properly initiated. Sounds an awful lot like authorization, and there's definitely going to be some overlap here because we don't think authorization is a traditional assertion. Speaking of which, there's authorization. Controls ensure that initiated purchase or sale and investment is properly authorized. So initiation and authorization would probably be an overlap. Again, I don't think this is necessarily a relevant assertion, which is why I kind of left it blank on there. But initiation and authorization would be authorization functions that relate to the existence of current step. We would want to separate these out. We would want to make sure that whoever's initiating the transaction is not the same individual who's authorizing the transaction. Then we have VAA. So making sure that the amounts that are being used for value investments or for financial statement purposes are appropriate. Now, is this an easy task for most organizations? Not so much. Investment valuation can be really, really tricky and can be really challenging, but we'll get to that here in just a second. Then presentation, ensure that they're properly presented and disclosed. And then classification, uses controls that ensure that securities are properly classified. You may have noticed that on this list of assertions here, these are first of all assertions that relate to account balances, assertions relate to account balances and to transaction events jointly. So account balances and transaction event jointly. There were a few assertions that I left off. Primarily, I left off rights and obligations for the same reason that we talked about a little bit earlier, but we're going to talk more about rights and obligations. It does kind of bundle itself with existence occurrence. So we're going to talk about that when we get to full account balance testing. But if we're talking about specifically transactions and events, you will notice that cutoff is not listed here. Cutoff is not a major assertion with respect to investments. It's very rare that we have cutoff issues with respect to purchasing of investments. Now, what did we say when we talked about equity with respect to segregation of duties? Was segregation of duties really important with respect to equity? We did say yes. We said true segregation of duties is really important. We identified some reasons why. The same holds true when we talk about investments. If we're talking about investments and transactions in this area, proper segregation of duties is really critical. And I alluded to that in the previous slide when I said the initiation function and the authorization function should be separated out. So let's look at some examples real quick, okay? So initiation function should be segregated from the final approval function. We just talked about that. That's separating out the reporting step from an authorization step. What about evaluation monitoring function be segregated from the acquisition function? So valuation monitoring, that sounds like something we would be recording amounts to the proper valuation of equity or not equities of the securities. Whereas acquisition, well, we know that the investments themselves are assets. So if we acquire them, then somebody's got custody of those assets. So we're talking about a separation between recording and custody. Responsibility of maintaining the security ledger should be separate from that of making entries into the general ledger. That's just a redundant recording step that we've talked about in previous situations. We've got recording that occurs in two different levels in the organization. And the responsibility for the custody of the securities should be separate from that of accounting for the securities. Well, that's obviously custody of securities, and that's then we talk about the accounting for the securities. That's another recording function. So some pretty clear examples of how these should be separated out. This is going to resonate a little bit more thoroughly when we start talking about how we audit these from a substantive perspective, substantive procedure perspective. Let's first of all talk about substantive analytical procedures. So there are first things we can note is that we can actually use comparison of balances in the current year investment accounts with prior year balances, so trend analysis. Comparative current year dividend interest and dividend income with reported income from prior years, so another trend analysis. We can also recompute the interest income using the face amount of securities held, interest rate, and time period held. Now you will notice here that it specifically relates to interest income. It does not mention dividend income here. Is it possible to develop a model on interest income? Yes, because we have predictable results. We know what the holding amount of the investment is. We do know what the interest rate is, or the average interest rate should be, and we know what the period of time is. What about for dividend income? The answer is kind of it depends again, because you know that I love that term. So what does it depend upon? It really depends on the nature of the dividends. If it's dividends on preferred stock, the answer is yes. We could develop an expectation because preferred stock have required dividend payouts. All right. What about for common stock? Are dividends required payouts for common stock? Learned about this in your accounting classes. Yeah, financial accounting. No. Common stock does not require dividend payout, okay? And many organizations don't pay out dividends. So we can't actually compute what dividend payout should be. So dividend income is not recomputable for common stock dividends, which tend to be the most common. All right, let's talk about some substantive procedures now in this area. Now, I don't want to go into detail on all of these because even though we can test all of our assertions in this area, our assertions in this area are going to be very focused on a few very specific ones. Okay, our testing in this area is going to be focused on a few specific assertions. So by and large, with respect to investments, what do you think the most important assertion would be for the auditor's perspective? What is the most important risk? That the investments themselves aren't actually there, that they're being overstated for some reason? If investment amounts are being overstated, what is that a violation of? Existence occurrence. Okay, so existence occurrence is a big one. Okay, so how do we test existence occurrence? The answer is if we have custody of the securities, then we have the auditor physically examine the securities. If the client has physical possession of the securities, or if they say they hold these in a safe deposit box. So say, for example, at the bank, we go to the safe deposit box and open it up and look at them and make sure that they actually are valid. That would be the primary way that we would want to test this. Now, you will notice there's a whole bunch of other ones that are listed up here. What if there's a third party that holds these investments on behalf of the client? Is that something that is legitimately done? Probably so, because it's listed on the slide here, looking at third parties, okay? By inference, you can say, that makes sense. Dr. Barnes wouldn't present this slide otherwise. Let's just hope that's the case. I've not tried to trick you just so far yet today. So third parties could be holding the investments on behalf of our clients. So we would want to send a confirmation out to the third party. So as we know, since we're talking about investments as an asset category here, that would be a good test of existence occurrence. There's also a kind of an ancillary test which provides less assurance. That would be reading executive partnership or similar agreements. Basically anything that represents the transactions related to the investments. That would provide us some documentation, but it would be a less stringent test than these areas up here, okay? All right, so that's one assertion. What about another assertion? What do we talk about with respect to the proper amounts with respect to investments? Is that easy to achieve? It's easy to determine? For most investments, they can be really, really complex. So if we're talking about the amounts that are associated with the investments, what's probably our second assertion? VAA, yes. So we're going to talk about how we actually approach VAA. So one of our primary concerns is the valuation of the investments, and so it's basically fair value, okay? So have there been any changes other than temporary to the fair value of the investment? Most investments do allow for adjustments to fair value. Now, what those adjustments are really depend on the nature of the investment, which we're going to get to in just a second. But what happens with respect to impairment? What if the fair value is significantly below the cost? So these are held at historical cost. Is an organization required to make adjustments for impairment? That's something that happens in financial statements if the carrying value is significantly below the cost of that investment. Yes, under GAAP, that's required in financial accounting. You have to make an impairment adjustment. Okay, so if the investment values are determined to be impaired, the security should be written down and a new carrying amount should be established. This is a particularly important area, particularly in a volatile area of investing, which does exist in this day and age. One area where this is going to be very prominent, and I tend to not bring this up because they're not traditionally investments, but have to do with crypto assets. Has anybody been paying attention to the FASB rules on crypto assets, how they're treated? So they're not investments, they're actually treated as intangible assets, which makes no sense, okay? But for our purposes of practical speaking, they are investments, okay? They're actually intangible assets that are valued like investments, which again, that's really, really confusing. That's not going to be on the exam. It's just kind of for your own personal knowledge, okay? For those of you who are going to the graduate program, we'll get to talk about that more later, I promise, okay? We get to talk about an AIS. All right, so we do want to make sure we have proper valuation and allocation accuracy associated with these items, okay? So then we have presentation and classification. We do know that there's different ways that investments can be held. There's three categories: held to maturity, trading, or available for sale. So depending on how they're held is actually going to depend on what the valuation method is going to be. So held to maturity, available for sale securities, they should be classified as non-current assets unless management expects to convert them to cash within 12 months. So unless they're going to mature or they're going to be sold within 12 months, they're always categorized as non-current assets. All trading securities, on the other hand, should be classified as current assets. So this kind of interesting point that we brought up before. Might our organization that we're doing the audit for, our client, Might they have a reason to want to classify something as a current asset that's not a current asset to inflate those current asset numbers? Yes, remember that current ratio that we talked about before that was so important? This is an area where we need to be very, very clear that proper classification is correct and that presentation within the financial statements are accurate. Related to that, let's talk about how we do the accounting for fair value management. So fair value measurement. So we're trying to determine proper fair value. Now, oftentimes we as auditors may not be able to do that on our own. We may have to employ a specialist, and we'll talk about that here in just a second. But for the most part, if we can do an analysis and evaluation, it would kind of shortcut a lot of the work we need to do. There are three things we need to know. We need to know what are the three fair value hierarchy methods that we need to be aware of. And the answer is it's level 1, level 2, or level 3. Level 1 is called mark to market, which if you ever paid any attention to Enron, you're probably like, mark to market's evil, Dr. Barnes. Don't mention that. It's like, well, it was in that situation, absolutely. But that was a different method of accounting than what we traditionally think about mark to market. When we talk about investment valuation, mark to market simply means that an investment is valued by the quoted market price. So you go and buy a stock in Amazon, a piece of stock in Amazon, you know what the market price is because it has an existing market for that particular investment. So that's easy. That's easy evaluation process. What about mark to matrix? Mark to matrix says that there's no existing market, but we can use the price of a similar asset to value the investment. So we invest in a company that's privately held. There's no market for it, or a client invests in a company that's privately held. There's no market for it, but they're very similar in context to Amazon as far as their operations. So we use the Amazon valuation to value the equity in this particular category. So is that going to give us a true valuation of what the market amount is? No, this is just an estimate. This is our best guess at that particular one. So it's a little bit more subjective. Then we have mark to model. Mark to model basically means there is no existing market. There's no similar asset. So we have to use what management thinks is the correct valuation for that. This is highly subjective and is very heavily scrutinized by auditors. Now, what you will notice as we move from level 1 to level 2 to level 3, we start replacing objective inputs with more subjective inputs. We don't like subjectivity as auditors. Subjectivity is the enemy, okay? But that is where our payoff comes because we have to employ professional scrutiny, problem solving, and judgment, okay? So that's basically what we need to be aware of is that if we have an established market, the valuation's easy. If we have a non-established market, valuation can be very difficult. So how do we go about that? Well, AUC 540 says that auditors should obtain an understanding of how management makes fair value measurements. So first of all, we need to understand what management's process is in order to be able to understand what the underlying valuation techniques are. We also need to consider whether specialized skills or knowledge are required. Now, unless you got a degree a backup degree or double major in actuarial science, you probably are not going to be able to do complex estimates, like especially the ones that are required for level 3 evaluation. So that might be where we have to hire an actuary to come in and actually do the analysis for us. We're then going to test the entity's fair value measurements and evaluate the reasonableness of the fair value measurements. Now, how do we evaluate reasonableness? The answer is it's very similar to how we would perform an analytical procedure. We probably would have a tolerable difference that we would estimate. That being said, it is a little bit more subjective. There are not specific guidelines in this area that say this is correct or this isn't correct. It's often just a matter of judgment on the part of the auditor to determine if this is going to be a fair estimate of the true valuation of the investment. With that, we are done with lectures. We've got one more homework assignment due on Friday. Please make sure you complete that, and I'll see you then.